The Chevrolet Silverado electric vehicle was introduced as a strategic pillar in the electric transition of General Motors. It was positioned not merely as a new product, but as a signal that legacy truck dominance could migrate into the battery era without material disruption. That assumption now warrants forensic scrutiny. The electric pickup segment is capital-intensive, technologically volatile, and brutally sensitive to macroeconomic stress. The Silverado electric vehicle entered this arena with extraordinary expectations, backed by multi-billion-dollar platform investments, dedicated assembly retooling, and aggressive production targets. Yet the financial architecture supporting this ambition is under strain. General Motors committed vast sums toward battery plants, Ultium platform development, software integration, and vertically integrated supply chains. While scale was projected to deliver cost efficiency, real-world conditions have proven far less cooperative. Battery input costs remain elevated relative to initial forecasts. Demand elasticity for high-priced electric trucks is narrower than anticipated. Interest rates have risen sharply compared to the ultra-low environment in which these capital commitments were approved. The Silverado EV is priced at a level that exposes it to tightening consumer credit conditions. Full-size trucks have historically thrived in strong economic cycles driven by construction, energy, and small business expansion. In a restrictive monetary climate, monthly payment sensitivity becomes decisive. The shift from internal combustion to electric adds several $1,000s in cost even before dealer markups and option packages. Mounting debt is not theoretical in this context. General Motors carries substantial long-term obligations linked to product development, pension liabilities, and manufacturing transformation. The electric vehicle transition compounds this leverage by front-loading capital expenditures, while revenue realization remains uncertain. If Silverado EV sales underperform expectations, the burden of amortizing plant investments and battery joint ventures intensifies. Electric trucks also face depreciation risk that is structurally different from traditional models. Residual values for electric vehicles have demonstrated volatility across the market. If resale values for the Silverado EV weaken, leasing arms must absorb higher losses. That feeds back into the balance sheet through credit exposure and increased provisioning. Operational infrastructure is another stress point. The Silverado EV depends on stable battery supply chains, specialized service training, and a dealer network capable of explaining and supporting complex software-based systems. Dealers that built their profitability around maintenance-heavy combustion trucks face margin compression when servicing electric platforms with fewer mechanical components. This reduces dealer enthusiasm, and it can weaken distribution commitment. Supplier stability cannot be assumed. The rapid shift to electric architecture reshapes the supplier ecosystem. Traditional component makers tied to engine and transmission assemblies face declining volume. At the same time, battery material suppliers and electronics providers gain strategic leverage. Any disruption in lithium, nickel, or semiconductor availability directly threatens production continuity. That exposure is magnified when production forecasts are high and inventory buffers are lean. Competition compounds the fragility. The Ford F-150 Lightning established an early foothold in the segment. Rivals from both established brands and emerging manufacturers exert pricing pressure. When multiple players chase a limited pool of early adopters, incentives escalate, and those incentives erode margins, especially when fixed costs are already elevated. There's also a risk of capital misallocation embedded in the Silverado EV program. Management narratives emphasized rapid scaling and technological leadership. However, scaling before achieving stable demand can create underutilized capacity. Idle or partially utilized plants represent stranded capital, and depreciation continues regardless of output levels. If consumer adoption stalls because of charging anxiety, range skepticism, or affordability constraints, the return profile deteriorates quickly. Liquidity pressure is subtle at first. It manifests in extended payables, rising financing costs, and asset sales. If EV programs fail to meet internal rate of return thresholds, credit rating agencies may reassess long-term debt sustainability. Downgrades increase borrowing costs, which in turn pressure margins across the entire portfolio, not just the electric division. Midway through this assessment, it is worth pausing to recognize the broader pattern of enthusiasm outpacing cash discipline in the electric transition. Please subscribe to our channel. We want to hit the 1,000 subscribers this week. Resuming the analysis, we must consider consumer trust. Full-size truck buyers value durability, towing reliability, and predictable total cost of ownership. Electric trucks introduce new variables such as battery degradation, software glitches, and charging network compatibility. If early production units experience recalls or performance inconsistencies, reputational damage spreads rapidly through contractor networks and fleet buyers. Fleet adoption was expected to anchor demand for the Silverado EV. Corporate sustainability mandates created theoretical volume pipelines. Fleet managers are ruthlessly cost-driven. They evaluate lifecycle expense, including downtime, charging infrastructure installation, and residual resale value. If real-world data reveals higher than expected operating friction, fleet orders can evaporate or be deferred. Charging infrastructure remains uneven across rural regions, precisely where full-size trucks dominate. While urban adopters may tolerate charging complexity, rural contractors prioritize EP time. Any perception that the Silverado electric vehicle compromises operational flexibility can materially constrain its addressable market. Another structural vulnerability lies in software integration. Modern electric vehicles function as rolling computers. Over-the-air updates, battery management systems, and driver assistance features require seamless coordination. Software development cycles are expensive and prone to delay. Bugs can trigger recalls that are financially and reputationally costly. Unlike mechanical fixes, software faults often attract regulatory scrutiny because of safety implications. There is also an inventory risk. If production ramps ahead of confirmed retail demand, dealers may accumulate unsold stock. Inventory carrying costs rise. Incentives increase to clear lots. Margin compression accelerates. A vicious cycle forms in which aggressive output targets collide with cautious consumer uptake. Macroeconomic exposure further darkens the picture. Commercial real estate contraction, slowing construction activity, and energy market volatility reduce demand for high-priced trucks. At the same time, inflationary pressure on insurance premiums and electricity pricing complicates the total ownership equation for electric pickups. If we analyze bankruptcy risk in probabilistic terms, the Silverado EV alone will not determine corporate survival. However, as a flagship EV initiative, its underperformance could symbolize strategic overreach. Should EV losses widen while combustion truck profits soften, cross-subsidization capacity shrinks. That scenario raises the probability of restructuring, particularly if global operations also encounter headwinds. There are early warning indicators to monitor: announcements of production pauses, workforce reductions at electric vehicle plants, delayed battery facility timelines, or revised capital expenditure guidance would signal stress. Credit facility drawdowns or asset divestitures tied to liquidity preservation would amplify concern. Each of these markers would shift the risk profile from a cyclical challenge to structural distress. For consumers evaluating the Silverado EV, the question is not technological novelty, but financial durability. Purchasing a vehicle from a manufacturer under balance sheet strain introduces secondary risk. Warranty coverage, software support, and resale liquidity depend on corporate stability. If depreciation accelerates due to oversupply or negative press, owners absorb the loss. Leasing may mitigate some exposure, but lease pricing itself reflects the manufacturer's confidence in residual value. Elevated lease rates or reduced incentives can be indirect evidence of internal caution. Service infrastructure is critical. Electric trucks require specialized diagnostic tools and trained technicians. If dealer profitability declines or consolidation accelerates, service access may narrow. Rural buyers in particular should assess the proximity and long-term viability of certified service centers. Insurance costs for electric trucks are trending higher in many regions due to battery replacement expense and repair complexity. Total ownership calculations must incorporate these variables. Savings on fuel can be offset by higher premiums and financing costs. Consumers should also monitor corporate communications carefully. Language that emphasizes strategic flexibility, portfolio optimization, or disciplined capital allocation can signal retrenchment. While such terms sound prudent, they often precede cost-cutting measures. Resale market liquidity is another barometer. If used Silverado EV listings increase sharply with declining price realization, market sentiment may be deteriorating. Early adopters often anchor resale benchmarks. Weak secondary demand can rapidly influence new vehicle pricing strategy. Battery warranty terms deserve close inspection. Degradation thresholds, capacity retention guarantees, and transferability affect long-term value. Any tightening of warranty conditions in future model years could reflect rising cost pressure. Buyers must also consider technological obsolescence. Rapid iteration in battery chemistry and charging speed can render early models less attractive within a short cycle. If newer competitors offer materially superior range or charging efficiency at similar price points, the Silverado EV's resale competitiveness erodes. In extreme stress scenarios, if corporate restructuring were to occur, parts availability and software continuity could become uncertain. While large manufacturers rarely disappear entirely, reorganizations can disrupt normal operations. Consumers should not assume seamless continuity under all circumstances. The Silverado EV represents a bold industrial transformation effort, yet boldness does not immunize a program from economic gravity. Debt accumulation, infrastructure complexity, and volatile demand intersect in ways that amplify downside exposure. Investors must evaluate whether projected volume and margin can realistically service the capital deployed. Consumers must assess whether the badge on the grille is backed by a balance sheet capable of honoring long-term commitments. As 2026 approaches, the electric pickup experiment remains financially delicate. Success requires disciplined production alignment with real demand, rigorous cost control, and stable credit markets. Failure to achieve these conditions would intensify restructuring risk across the broader enterprise. The message for stakeholders is clear. Scrutinize cash flow, monitor leverage ratios, observe inventory levels, and watch for rating agency commentary. Optimism is not a substitute for solvency. The Silverado EV's future will be determined not by promotional narratives but by its ability to generate sustainable returns in a tightening economic environment. Please subscribe to our channel. We want to hit 1,000 subscribers this week.